Introduction: the textbook trap. I want you to picture a scenario. You're sitting at your desk, staring intently at a chart. Right, doing the work. Exactly. You've studied the cheat sheets, printed them out, maybe even taped them to the side of your monitor. You've memorized all the classic candlestick patterns. Oh yeah, every single one of them. And then, there it is. You see a perfect doji forming right where you expected. Or maybe it's a classic hammer, or a massive bullish engulfing candle breaking through a trend line you just drew. A textbook setup. Right. You recognize the shape flawlessly, so you execute the trade exactly like the textbook told you to. And then, almost instantly, the market violently reverses. Yep, every time. It slices right through your position, hits your stop loss, and you're just left staring at a red screen, completely paralyzed. You're left wondering why your trade failed when the pattern looked absolutely perfect. It is an incredibly frustrating experience, and honestly, it happens to almost everyone who steps into these markets. That psychological fiction is exactly why we're doing this deep dive today. Dismantling the pattern myth. We're looking at a huge stack of sources focused on professional Forex trading, specifically looking at the mechanics of price action and the behavior of XAU-USD, gold, which is a beast of a market. It really is. And our mission today is to completely dismantle this false belief. We have to stop viewing candlestick patterns as secret market signals, or like magic cheat codes, right? Exactly. They aren't. Instead, we're going to break down how to read them for what they actually are, which are behavioral footprints of extreme buying and selling imbalances. I love that phrase, behavioral footprints. Yeah, we're going to explore why a geometric pattern without structural context is, well, completely useless, especially in a highly volatile market like gold. And most importantly, we'll talk about how to stop being the target of institutional traps. The language of the market, beyond memorization. The most disastrous mental mistake I see beginners making is treating market analysis like a grade school vocabulary test. Oh, absolutely. They focus all their cognitive energy on memorizing the names of the patterns. Right, they point to the screen and say there's a morning star and there are the 3 black crows, but they have no idea what the psychological story behind that specific candle actually is. You're missing the entire narrative. It really reminds me of memorizing a list of foreign vocabulary words without ever bothering to learn the grammar. Yeah, that's a great analogy. Like, sure, you can identify the individual words on a page, but you absolutely cannot read the sentence, let alone understand the nuance of the story. And if you don't understand the language, you're just guessing at the meaning. Every single candlestick is a documented visual record of a psychological battle, a battle between buyers and sellers. Exactly, over a highly specific period of time. Anatomy of rejection, body and wicks. Consider the body of the candle. The body represents momentum and conviction. Momentum, right. A massive, thick body extending in one direction tells you that one side had aggressive, unyielding participation. They didn't just push the price slightly, they flooded the market with volume and held their ground. So a massive green body isn't just a quote bullish signal, it's actual physical evidence that institutional buyers stepped in with serious, heavy-handed volume. Precisely, they committed capital. But what I find far more fascinating are the wicks, or the shadows, whatever you want to call them. Oh, wicks are everything. Right, because early on, those thin lines extending above or below the body always seemed like just market noise to me, but they're actually the most crucial piece of the narrative. A wick is essentially a scar on the chart. A scar, I like that. Yeah, it shows you exactly where the price attempted to go, but was forcefully, sometimes violently, rejected. The wick is the scene of the crime. Structural context, BOS and choch. The exact same geometric shape can mean entirely different things depending on where it appears on your chart. Yes, This is huge. A hammer pattern right in the middle of a choppy, sideways, consolidating market. It means absolutely nothing. Just random algorithmic noise? Exactly. But a hammer pattern forming after a brutal 3-day downtrend, right at a major historical level of support, that represents a massive shift in underlying psychology. Context is everything. To understand this context, the research introduces Hai Hai Nim Quan Trunk, BOS, break of structure, and COCH, change of character. A break of structure occurs when the price pushes beyond a previous significant swing high or swing low. The second concept is choch, which happens when the price breaks a key structural swing against the prevailing trend. It acts as an early warning system that momentum la jit twirn, engineering liquidity. The institutional strategy. To determine if a structural break is genuine, you cannot rely on lower timeframe wicks. You must look for a decisive candle body close beyond the structural level on a higher time frame like the 4-hour or daily chart. In gold XAU USD, those fake breakouts are practically a daily occurrence. The institutions are the ones deliberately selling into that massive wave of retail buying. We have to understand the mechanics of why these fakeouts happen so frequently. It fundamentally comes down to liquidity. Large institutional players need massive, almost unimaginable volume to fill their block orders. They require a massive, concentrated pool of opposing orders to fill their position. They are engineering a collapse of retail positions to build their own. The institutions are engineering liquidity. 7. The Asian Session Trap. Let's look at the Asian Session Blueprint, which our sources highlight as one of the most consistent institutional traps in the XAU USD market. During the Asian trading hours, gold often moves sideways in a tight, boring consolidation box. Retail traders buy the bottom and place their sell stops just below it. Right, and they sell the top and place their buy stops just above it. And then London wakes up. The London session opens and massive institutional volume floods into the market. They aggressively drive the price down first. They push the price right out of the bottom of the Asian consolidation box. Panic sets in. The institutions step into this engineered panic, absorb all of those forced sell orders, and fill their massive long block orders at a steep discount. Once their orders are filled, the selling pressure vanishes and they violently reverse the price back upward. The wick is the permanent record of the trap. Professional execution and risk defense. The execution sequence requires tremendous patience. You have to wait for the trap to be sprung on everyone else first. Waiting for the sweep is the hardest psychological hurdle. After the sweep, you are looking for a massive high-volume candle moving aggressively in the opposite direction. Displacement. You don't chase the displacement, you wait for the market to come back to offer you a fair price. This introduces the concept of the fair value gap, or FVG. Your stop-loss placement becomes structural and logical. You place your stop-loss safely beyond the extreme wick of the sweep candle. You are essentially putting your safety net behind the institutional firewall. Professional traders wait for high-volume trading sessions, specifically the London and New York Opens, the kill zones. Context is the only thing that matters. Take a long, hard look at your charts today and ask yourself who is really in control of the setup you are looking at.